Hi guys, how are you? This one Titanium, founder of Investing MMT and the co-founder of Pure MMT for the 100% Beyond the Memes, along with my friend Edward Delzio, who is the author of The National Debit. And I also run a Patreon page where for $5 a month I will teach you how to apply real MMT to the real world and how to invest using that knowledge. And the only reason I charge $5 is to keep the trolls out. So in this video we're going to talk about the doom and gloom porn pumpers. And there's a lot of them out there. Most of you guys know me from This One, my old YouTube channel, where I debunked all these fools. And I've done it for almost a decade now. And it's fun, but there's a learning lesson in having fun with these crazies. So in this video we'll also explore what's going to most likely occur in 2018 and some basic information into really understanding MMT, modern money, and macroeconomics. So first let's start with this guy, Harry Dent, calling for the market crash in 2013. Woohoo! Right? How fucking wrong was this guy? Here he is again, Harry Dent, predicts most dangerous investing period in 2014. Boy, was he wrong. How about the little golden boy from Goldman Sachs, Mr. Real Vision? Every fucking year he comes out with some macro call that he charges. I don't know how much he charges, $10,000 for his stupid newsletter. And every year, you know, it's doom and gloom. And he's wrong. Let's take a look at this one. This is a beauty.
I am concerned about the high yield market. I think that's in a major bubble, but I won't say to short it tomorrow.
This market keeps going up and up with zero interest rates, and that's what's really pushing it.
It sounds like you're saying this could be the beginning of something problematic.
I think it's not will it happen, it's when it will happen.
There's one investor out there that a lot of CEOs just have to take the phone call from, because when you get a call from this guy, Carl Icahn, he probably wants to shake things up a little bit.
Icahn giving his thoughts on stocks broadly. I believe the market is extremely overheated. Also, if more respected investors had warned about the market in '07, we might have avoided the crisis in '08.
Overall, the U.S. equity market, do you think it's in store for a dramatic pullback?
I've been worried for the last 5-6 months about the market and the economy and in the dangerous spot that we're in.
Okay. I posted this video on my old channel, This One, before it was taken down. And I laughed at him. Okay, and I said, listen to this bullshit. You know the market is going higher. And sure enough, here we are, 2018 just about, and the market has just soared up. I think almost 34, 39%, I'm not sure. Okay? Screamed higher. You want to listen to this guy?
4 or 5 times warning about the problems we have. I want to speak out now.
The bleeding heart.
Because I know this may sound corny, but I grew up in the streets of Queens. Yeah. I love this country.
There you go.
And I feel so strongly about the dysfunction that is going on both in Washington and the boardrooms of corporate America.
The bleeding heart is going to come out and tell you how, you know, you should just be careful. I mean, come on, man. Come on. How about this sourpuss over here? Right? Every single year, something bad will happen eventually. Dow hits record high. Like I told you, I've been doing this for almost a decade. Okay? And I've been making fun of them. All of them. But, you know, you don't see me on CNBC, do you? They've all been wrong. All of them. Right? But I'm not on CNBC. My little dumbass is charging $5 a month to tell you what reality is, to tell you the truth, to tell you real news, to tell you real economics. Okay? But But these guys get paid, millions and millions and millions of dollars to tell you bullshit. Or how about this clown?
The great unwinding has begun. That's what.
How about this retard?
And when this one pops, it's not going to be the third, the third time's the charm. It's going to be 3 strikes, you're out, because I think that this bubble is too big to pop. I think it's the mother of
the mother
of all bubbles, and when it bursts, there is not a bigger one.
Of course. Fucking 2 decades, the same old fucking line, huh? And they're all wrong. Okay, so real quickly, please analyze this chart. I want all you little moving averages and candlesticks, hakamokochiko indicators, and wicks, support and resistance, and vague hunches and feelings, and it's just too high. I want you to analyze this chart. Just take your time. Don't rush. Tell me all about RSI, stochastics, and MACD about this chart. Take your time. Pause the video if you have to. Observe it really, really closely and tell me what's going to happen next. Tell me all about America's in decline and, we need jobs. We need a job guarantee, a Soviet-style job guarantee, and universal basic income. Analyze that for me. Can you? You can't. Okay? You cannot analyze this chart. And the reason you can't analyze that chart is because you don't understand what the savings bubble is. Okay? You have no clue. Alright, so now analyze this chart. Tell me all about it. Tell me where there's support resistance, wicks, okay, and anything else you can come up with. I'm sure all of you can have an opinion about this chart. But when I tell you, giving an analysis on this, you have no idea. So if you really want to learn how to invest and you really want to understand how it all works, come down, $5 a month. Believe me, I'm not making money off $5 a month. Come down, subscribe, and I will teach it to you. And I'll give you some basic outlook for 2018, and we'll get started with that now. We'll start off with Harry Dent back in 2013. It was in January, and just like I told you, you can't analyze nothing, right? When he was saying all this nonsense back in 2013, down here, if you can see it over here, okay? This is what he saw, and this is what everybody saw, but they couldn't analyze what didn't exist. So they figured, hey, it went up enough, well, it's time for it to come down. Based on what? Vague hunches and feelings. In 2015, we had Carl Icahn come out and says, I'm concerned about America. Oh, they're bleeding hard. He's just a poor child, and wherever he's from in New York, and he's barefoot and he's walking to school, with snow, in the snow, and everybody said, well, this is just, yeah, he's right. It's just up too high, right? But again, he could not see what was up here. He cannot analyze it, okay? I'm sure he does, but he's not stupid. But he is bullshitting you, okay? And the reason all these people can bullshit you is because you can't analyze this. You don't have the tools, you don't have the understanding to analyze something that doesn't exist. So as long as we put something into the future, something that's blank, something that doesn't exist, something bad will happen eventually, thesis. Okay, they can get you to believe anything they want based on the future. And then you get idiots like this, that run around and tell you, oh, we need job guarantee, we need a job guarantee, we're doomed, America's in decline, can't you feel it? Nothing but doom porn pumpers, all of them. Alright, so I'll try to explain it to you, even though you probably won't, most of you won't understand it, but you should. The first thing you need to understand is that government debt, all government debt, equals private sector assets. Okay, government debt equals private sector assets. Okay, first thing you have to understand. So that means all the deficits are net financial assets to the private sector. The question you have to ask yourself is, to whom in the private sector is it an asset to? And the vast majority is to the top. Okay? And this is what I call the savings bubble. Right in here. That's where all money flows. And these people don't put their money under the mattress. What they do is they go out and they buy stocks and bonds and whatever, and they borrow against that money. Okay? They borrow that money and they push prices higher. If you understand this as being the center of the economic universe, the center of the investment universe, then everything else is quite simple. Okay? And here's the way it works. As long as the government deficit spends, which is the total amount of money it spends minus the taxes and it collects, they are net financial assets to the private sector. Okay? They don't stay in the functional economy. They end up all in the private sector. Okay? Savings. Now, you can go out and you can borrow on those net financial assets. So the way it works is you get a net financial asset, okay, right here, the dollar. Then you can borrow against that dollar, okay, and then all those dollars end up in the, let me put them all together, okay, all of them combined end up in the non-productive savings, okay, and then they go into the stock market and prices go up. So as long as you understand that little piece, you should be good to go. So just like net financial assets that are total spending minus taxes, okay, I'm going to introduce a non-technical, it's incorrect technically, okay, but I'm going to introduce a new concept, that all borrowed money minus the servicing of that debt, okay, equals net deficit financial assets to the savings bubble. Okay, I hope that made sense. So as long as you can service whatever debt, you can borrow $1 million. As long as you pay that $10,000, that $1 million is going to stay in the savings bubble. See, savings don't give a shit where the money comes from. It doesn't care if it comes from exports, if it comes from loans, if it comes from asset sales, government deficits. It doesn't matter. It doesn't care. All the only thing it knows is that those dollars exist in savings to somebody. And as long as those dollars remain in savings, guess what? That asset price is going to grow. Now, what is more important to understand is not only does those dollars in savings that exist go into asset prices, but you also can borrow against those assets and juice up that price. Okay? Margin debt. And let me show you a picture with that. And here it is. Okay? You see it? Margin debt, which is in white, and the Dow Jones, which is in yellow. Moving up very nicely. So all these dollars, which is in yellow, these are net financial assets. And then on top of that, they go out with debt, and they juice that amount up, pushing the price higher and higher and higher. So one of the great questions I got is, well, Nick, where does the money go once the market starts to go down? What happens? Where do they put all that money? Well, they're not the actual net financial assets. Okay, they're in the savings. They don't go away. What does go away is the debt. Okay, it's this debt that goes away. Because see, if you repay debt, you're actually destroying those net deficit financial assets. Okay, they're destroyed. They're gone. But the net financial assets, they still remain. They don't go anywhere. You can't destroy them. The only way you can destroy them is if you start running surpluses. So until you do that, and that's not going to happen anytime soon, okay, you're going to see that stocks will continue to rise. So as long as you keep pumping net financial assets and net deficit financial assets, and remember that you're getting loan growth inflation, that if I loan 10 million today, tomorrow I'm going to loan 100 million, and then the following day I might do 50 million, and then the following 200 million. So you get that loan growth inflation that's constant, okay, and just keeps growing over time. So whatever servicing payments there are that are destroying those net debt financial assets by repaying the debt, there's always going to be more debt that's going to keep pumping into the unproductive savings. And again, as long as you keep feeding the savings bubble, you're going to get higher asset prices. So think of it like this. I go out, I borrow $100,000, I buy, I don't know, whatever, a ring from you, okay? Now you have $100,000, and you're going to do what with that money? You're going to go and you're going to put it in the bank, okay? So I created $100,000 out of thin air by borrowing money, and then you took that $100,000, it's income to you, and then you save that money in the savings bubble. If I default on that $100,000, let's say, forget it, it's gone, okay? Is somebody going to come in the savings bubble and take that $100,000 from you? It's not going to happen. Those dollars are stuck there. See what I'm saying? That's the way it works. Now, yes, the bank is screwed. Yeah, we got that. Okay, they're minus 100 grand. Okay, but remember, as long as the loan, there's loan inflation. Okay, this bank can always go and borrow from somebody else to cover that loss. Okay, and remember that there's always about a 5% default rate, which is already priced in to the interest rate. Now, when the house of cards comes down and everybody's losing money like they did in the great financial crisis, then in that case, yes, everybody's screwed, because all that money is being unprinted, right? And then because debt is being either written off or paid back or whatever, everything freezes, then yes, the savings bubble starts to erode or shrink or whatever, and then of course stock prices come down. If that were to happen, then believe me, I'll be the first one to tell you, take your money out of stocks. But I don't see, there's no evidence of that happening. None. So if you want to analyze this chart, okay, there's nothing on it. You want to analyze it, it's very simple. First of all, I want you to start thinking of this as the savings bubble, right in here, okay? And the next thing you want to do is put government over here, and I want you to put banks over here, okay? Now, will government deficits increase? If that's true, and they do increase, then there will be more money in the savings bubble, okay? Because government debt equal private sector assets or savings, okay, to somebody in the private sector, just not to you and me. Well, not the vast majority of it. If net financial assets increase, you can then borrow on those net debt financial assets. Okay? So that means if there's deficits, then more likely than not, there will be more loans, and those loans are going to end up in savings. They're going to go through the functional economy, do what they have to do, but ultimately they will end up in the savings bubble. Now, if we rent exports, then we would add that too, but we're not going to do that anytime soon. Okay? So we know that over time, if we continue to increase the amount of net financial assets to the private sector, and they will borrow against that, then suddenly, you know what you're going to see? You're going to start seeing this stock price start coming up here like this. Okay? That's what you're going to see. And then you can analyze stocks from this. That's the way it works. So let's take a look at the evidence. The Congressional Budget Office has deficits increasing until 2027. Okay? You see it? So that means there's going to be more net financial assets that are going to be pumped into the savings bubble. Now, here's the biggest problem that most, doom pump Facebook / YouTube commentators that think they're economic experts, okay, they all think that we have this big debt crisis. That this is the orange slash red line, okay? That there's this just way too much debt in the system. Everybody's screwed. Everybody's in trouble, and everything is going to implode and just explode. Okay, so this is what it looked like in 2007. See, they would be right if they only said this back in 2007. Here's reality. This is reality. Okay, we are not at the top here. We are down here. This is more normalized. Okay, it's not perfect, but it's more normalized. Okay, we can certainly take on more debt. It's not a problem. How about debt servicing payments? Well, if you go back to 1980, they've never been lower, and that's this little blue line. Okay, this is 1980. Okay, we're below that. Again, not a problem. Total debt, yeah, total debt is much higher than it was in the 80s. Okay? No question about it. But the servicing, and that's what we care about. Remember, it's a servicing. Can we service the debt? And the answer is yes. We're a multi-decade low. So let's look at total consumer credit owned, okay? And that's the blue line. And you look at the S&P 500. They are parallel. See it? Moving up very nicely together. So you have no problem with debt. It's growing at the same rate as the S&P 500. Here's the same chart, okay? But this is a change from a year ago. And as you can see, right in here, you got a drop in consumer, and you got a drop. It's not really necessarily a drop. It's just a growth rate reduction, okay, in the S&P 500 in 2015 and 16, and then recovered in 2017, okay, late 2016. All right. So there's definitely you need credit in the system. When the credit growth slowed, did the market crash? No, it didn't crash. Okay, so it could happen again. Doesn't mean it's going to crash. Okay, so now that we looked at the evidence, well, we know that deficits are going to increase from the government, and we also know that loans are very healthy and they can continue to grow, no problem. Therefore, you're going to get more savings into the savings bubble, and then asset prices are going to rise, and they're going to borrow against those asset prices, and they're going to juice that growth rate up. So this picture kind of helps you think about it in the way that I'm trying to explain it, and keyword is trying. Okay, because it's really quite simple. It's just the way people think. It's kind of hard to convince them. So this guy goes out, he borrows money, and then these guys take all those savings, and they just go off into the savings bubble, and they speculate on stocks, or I should go like this, and they speculate on stocks, and make a shitload of money, making capital with capital. Okay, but as long as this guy can sustain the debt, okay, that service payments and loan growth, loan growth, inflation keeps going, and he keeps servicing that debt, that's going to keep pumping into the savings, and from that we can understand that stock prices are going a lot higher. So if everything is so hunky-dory, there's nothing stopping us, right? Well, no, it's not that easy. That's where charting and understanding what the market is doing, that you have to develop a little bit of understanding and skills. Now, we haven't had a correction of more than 5% in all of 2017, basically. Okay. This is not normal. It's rare. It does happen, but it's not normal. Okay, so what you'll probably get, and this is what I'm thinking in 2018, at some point you're going to get some kind of a correction. This correction, I don't know how deep it's going to be, but anywhere between 10 to 20 is just a correction. 10 to 20% decline is a correction. It's not considered a recession and a bear market and all that nonsense. Okay, it would have to exceed the threshold of 20% to be a bear market. So what you'll probably get is some kind of a pullback. This pullback should be bought, okay, just like all these other ones. They should have been bought, okay, and then the market's going to turn around and go right back up. So with that correction in mind, when we take a look at the chart of the S&P 500, for example, okay, what you're going to see is that you'll probably get, and I'm not saying it's going to happen now, I'm just saying at some point you're going to get some kind of a correction, okay, and then from that correction you're going to turn around and continue higher. That's the way it's going to work out. Now, you know, there's always caveats to things, and this is why, you know, I can tell you this and you'll think you can go out and invest just based on this knowledge alone, and that's not the way it works. There's always things that you have to be careful about, but generally speaking, this is the way it works. You'll get a correction and then it's going to turn around and then start shooting up towards the moon again, and everybody's going to sit there and be like, what the hell is going on? You know, this is a bubble, this is manipulation, this is whatever, you know. Yeah, but it's not. It's not, because you don't understand the savings bubble. And by the way, on this chart, this is when Carl Icahn came out, right in here, fear-mongering everybody, and the market since has been up 40% just about. Okay, so don't listen to these people. These people, they're not here to act in your best interest. They don't give a shit about you. Okay, they care about making money. They're not rich because they care about you, these bleeding hearts. Anyway, so getting back to the caveats. So the first thing is that earnings yield is at 4%. Now, the market hasn't really gone up with much less earnings yield than 4. It's always been above 4 or right at 4. Okay, and continue to push higher. The other one is that we are running deficits of only 3%. Now, let's talk about this for a second. Now, I know a lot of people don't understand this, and I'm going to explain it to you now, that when deficits are 3% and we are our net trade is also 3% of GDP, we are essentially running a balanced budget. Because if the government is printing 3% of GDP and we are importing 3% of GDP, okay, importing means we're exporting dollars to the rest of the world, all right, then the net effect is 0. They cancel each other out. So where is all this growth coming from? Well, it's coming from two places. It's coming from people saving less, which is pumping money into the functional economy, and it also comes from private debt. Remember that you can always borrow against those net financial assets, right? So those dollars are being pumped into the savings bubble. It's going through the functional economy, and then the functional economy, it goes into the savings bubble, and then asset prices rise. So we know that deficits are going to rise over the next 10 years, but we also know that the imports are rising or increasing as well. So what are imports? Remember, imports are exporting dollars to the rest of the world. If we are exporting more dollars to the rest of the world, you should also think of that as a net financial asset to the rest of the world, because they're receiving those dollars. And as the world reserve currency, it is up to us to feed the rest of the world dollars so they can grow their economies. Okay? Whether you agree with that or not or whatever, it's a good thing, and if we were to start running surpluses, we would starve the global economy of dollars, and then that would have an impact that is very negative, not only for the rest of the world, but also for the U.S. So as you can see, back in 2008, what happened to imports, right? They decreased dramatically. What happened to emerging markets and the rest of the world? Clump. World trade went to shit. Okay? Since then, we have been increasing it. We came to a bottom, we kind of decreased it in 13, 14, and then it started to improve again. Okay? So we're increasing our imports, which means we're exporting more dollars to the rest of the world, which means what? That the rest of the world is going to have more dollars and be able to grow at a faster rate. Now, if you go back in time and you look at what happened in 2002 until 2007, all those dollars being pumped into the rest of the world, what happened? Emerging markets exploded. Okay? They just boom. Everybody was about emerging markets. Well, guess what? If this trend continues, and we are predicting that it will, then emerging markets are going to outperform the U.S. So let's take a look at world GDP as per the IMF. We are seeing that uptick. See it right in here? World's going to grow at 3.6% in 2018. This is all those dollars being pumped into the global economy, and it's creating that trade. And that trade is pushing up GDP growth thanks to those imports from the US. So what does the emerging chart look like? Okay, this is a weekly emerging market chart. And again, you can't analyze what doesn't exist, right? But you can analyze what we're doing right now. And I'm telling you that if imports continue to increase, and I think they will, okay, there's no reason to believe they're not, and GDP growth is, increasing, and global trade is increasing, then what you're going to see is this is going to continue to go all the way up, if not all the way to the top here, which is about 30% rise at least. Okay, just the way it is. More money is going to flow into emerging markets than it will in the U.S. So, just to recap, in order for you to understand where the market is going to go, you have to understand where the savings bubble is. And I don't want you to tell me about politics or Trump or tax cuts or any of those things. Okay? What I want you to, it didn't matter in this chart that goes back to 1975. Didn't matter who was president. Was it the left? Was it the right? Who controlled the Senate? Who controlled the Congress? What were interest rates? What were, whatever the projections were, whatever the unemployment number was, where interest rates were, it doesn't matter. As long as you are feeding the savings bubble, then you will see prices rise. It's just really that simple, okay, to understand. And this is long term that I'm talking about. Now, in the shorter term, okay, this is a problem that we haven't had a correction in about a year, and we'll get one, and that's okay. There's nothing wrong with it. It could be up to 20%. I don't know how much. I can't tell you what the future is going to hold. That is not my job, but I can tell you that over the course of time, that prices will go higher, and if we do get a pullback, we should buy it. Okay. The other thing that you should remember is that savings, okay, if they start to reverse, they're low and they're going lower, but if this starts to reverse, that this might be a little bit problematic in the sense of the growth rate might not grow as much, okay, but it doesn't mean it's the end of the world. Keep an eye on loan growth. Okay, so loans and credit is increasing. It's looking fine. Nothing to be too concerned about. We had that little dip right in here in 2009 and 2010, and then it started to rise. Everything is looking okay. But again, if you start getting caught up in this politics and you start telling me about, that a certain area of the economy is inflating and another part of the economy is deflating, and you want to make some point, and it doesn't matter. I don't care what your politics are. It doesn't matter to me. It doesn't matter to this chart, because GDP growth, this is real gross domestic product, okay? So it's inflation adjusted, is going to continue to grow. And as it continues to grow, the savings bubble is going to grow and asset prices are going to rise. If interest rates continue to rise, and we start seeing that the earnings per share yield for the S&P 500 is not rising, it's kind of stuck in that 4% range, and then the yield curve continues to flatten out, and interest rates are rising, and so on. Okay, then we'll talk about it. But that's what we're here for, right? We analyze these things every day. So my prediction, 2018, you want to be more in emerging markets than you are in the U.S. Both of them are going to rise. We will have a correction. Nothing wrong with the correction. It should be bought, and we're just going to continue plugging along and pushing higher. And every tick that's going to go higher, you're going to have these people who are just, doom and gloom, and they're going to say it's manipulation, it's false, it's bullshit, and the whole time this that you cannot analyze, suddenly it's going to start to make sense, and this is bullshit, and this is not good, and Trump, and whatever, and the market is going to come in and keep going higher and higher. I know, and I get that a whole bunch of people like, just tell me what to buy. Tell me what to buy. Did I make money tomorrow? Okay, just tell me what to buy. I buy this. Okay, see, I'm smart. I made money. I get that. Okay, and all they give a shit about is, what's the next trade? Come on, tell me, what's the next trade? We buying? What are we doing? Don't be that guy. Be patient. Relax. There's a time to make money, a time to be in the market, time to be out of the market, and a time to be short the market. Okay? Just relax. Let this sink in. If you want to learn more about how to understand macroeconomics, and you can do this on your own, come down to Patreon. Join us for free at IMMT. Join us on Pure MMT for the 100%. And start to understand the savings bubble and, what it all means to just about everything. Politics and, what is the best political decision, and who should you vote for, and then you can start talking about politics, but not when it comes to investing. Okay, all you need to know is the savings bubble being fed? If it is, it's going higher. That simple. That's it. Happy New Year. Enjoy your time off. I'm sure most of you are not working. And I'll see you in 2018. Take care. Bye-bye.